These mass sales add to the selling pressure in the market, pushing prices down further. This new price decline triggers more margin calls, creating a domino effect that can unfold very quickly. In July 2025, a massive cash out on Aave v3 Core caused ETH borrowing fees to spike, extending the ETH unstake time on the beacon chain to 13 days and exacerbating the situation as looping strategies became unprofitable. This incident demonstrates how closely interdependent components in the DeFi ecosystem are and how quickly risk can spread. Debt explosion. If market sentiment and structure are the fire that fuels volatility, then leverage is the crude oil that fuels it fiercely. Leverage in the crypto market is a common practice where traders borrow capital from lending platforms, CeFi and DeFi, or brokers to increase the size of their trading positions. By using leverage, a trader only needs to provide a small portion of total value of their position to gain control over a much larger amount. This can multiply profits if the market moves as predicted. However, it also multiplies losses proportionally. The explosive growth of leverage in the crypto market is one of the main indicators of how volatile the market is. According to a report by Galaxy Research, total crypto collateralized loans jumped to $53.1 billion in the second quarter of 2025, the highest level since 2021. This figure shows that a lot of new funds are being borrowed for speculative purposes. Leverage is not limited to individual traders. Public corporations are also involved. A Galaxy Digital report shows that Bitcoin treasury companies, digital asset treasury companies, collectively have $12.7 billion in debt. Companies such as Strategy, formerly MicroStrategy, have issued billions of dollars in debt just to buy Bitcoin. Derivative contracts, especially perpetual futures contracts, perps, are the main instruments in which leverage is used. Perps contracts allow traders to speculate on the price movements of crypto assets without physical ownership. High leverage is a core feature of these contracts. In Q2 2025, open interest, the total number of contracts that have not been settled in the crypto derivatives market, reached $132.6 billion. Perps contracts accounted for approximately 93% of all crypto derivatives traded. While leverage increases market efficiency by enabling arbitrage and 24/7 trading, it also dramatically increases risk. In turbulent market conditions, even a small price decline is enough to trigger mass margin calls. When Bitcoin fell from $124,000 to $118,000 in recent weeks, it triggered more than $1 billion in long position liquidations in the derivatives market, the largest liquidation since August of the previous year. Volatility in the crypto market, although often seemingly random and triggered by internal factors, is actually closely linked to the global economic mainstream. Macroeconomic factors, including central bank monetary policy, inflation, and geopolitics, have an increasingly significant impact, especially since the entry of institutional investors. For example, when the U.S. Federal Reserve, the Fed, raised interest rates to combat inflation, it caused a major bear market in the cryptocurrency market in 2022. Rising interest rates made risky investments, such as stocks and cryptocurrencies, less attractive compared to risk-free assets such as government bonds. This created a stronger correlation between the crypto market and traditional equity markets, a significant shift from the image of a standalone market. Political uncertainty and government policy are also major sources of volatility. A country's monetary policy, such as massive money printing, quantitative easing, can encourage investors to seek refuge in assets such as Bitcoin as a hedge against fiat currency inflation. Conversely, anti-crypto policies can cause sharp declines. For example, the Chinese government's ban on crypto mining and trading in May 2021 caused the price of Bitcoin to plummet from $65,000 to below $30,000. At the same time, positive political support can lead to spectacular surges. President Donald Trump's March 2025 announcement of the creation of a strategic reserve of crypto assets, including Bitcoin, Ethereum, Solana, XRP, and Cardano, caused Bitcoin prices to rally from $85,000 to $95,000 in just one day. However, uncertainty can also come from the same policy. The announcement of import tariffs the following day caused a massive sell-off and a drop in Bitcoin's price back to $82,000. In April 2025, President Trump's announcement of reciprocal tariffs caused Bitcoin's price to fall below $80,000 and the U.S. stock market to plummet. Institutional adoption has been a major driving factor in the crypto market's connection to the global economy. Following the approval of spot Bitcoin ETFs in the U.S. in 2024, billions of dollars from institutional investors entered the market through BlackRock, Fidelity, and ARK Invest. Inflows into Bitcoin ETFs exceeded $10 billion in the first quarter of 2025. This adoption has given the crypto market a new layer of stability, as institutional investors tend to have a long-term view and are less affected by short-term volatility than retail traders. Bitcoin advocates such as Injective CEO Eric Chen cite post-ETF demand from institutions like MicroStrategy and GameStop as supporting Bitcoin's resilience. However, despite increasing institutional adoption, the crypto market remains sensitive to macro signals. Expectations of a Fed rate cut in 2025 and legislative progress such as the Genius Act in the U.S. in July 2025 provide positive sentiment that supports the market even without a centralized circuit breaker. So, the crypto market does not exist in a vacuum. It is part of a larger global financial ecosystem, and its reaction to events outside of it is an integral part of its volatility.